Welcome everyone. This is Dragon Argent webinar on mergers and acquisitions. My name is James Kearns. I'm the head of the legal team here. Just for those of you who aren't aware, Dragon Argent is a multidisciplinary professional services firm providing advisory, legal and accountancy services, principally for high growth SMEs and startup companies. So we deal with a fair number of M&A transactions, investment and other matters. So the plan today is to take you through the basics of M&A. We don't intend to go into a huge amount of detail. What we're trying to do is make this useful for founders of companies to give founders an idea of the kinds of things that they need to consider when looking potentially to sell a company. So in brief, we'll look at the different types of M&A transactions, a little bit around the tax treatment of the different types of structured deals that can be done. We'll look at a brief scenario. And as I say, we'll concentrate mainly on what founders should be considering in the run-up to a sale. And we'll also touch upon the process and the mechanics of these transactions. We'll have time for questions as well. If you'd like to put any questions in the chat as we go along, that's great. I'd perhaps leave them slightly towards the end of the webinar, and we'll have a chance to answer those as well. As I say, my name is James Kearns. I'm head of the legal team. I have with me Freddie Brace, who is the head of our corporate and commercial team, James Taylor, who is our CEO, as well as Craig Williams, who is head of accountancy and also our CFO. Right, so I think we're just going to start, given the title of the webinar, just to understand, Freddie, if you could start, just explain what a merger is, what an acquisition is, and what an exit is, kind of in brief terms as possible.
Yeah, that's a really great question, because there are so many different types of transactions that can come under those headings. Obviously, for you as founders, your transaction will have its own nuances. So it's not a one-size-fits-all categorization. But to be brief and to put it in the most basic terms, a merger you should think of as something that when two companies come together, they want to work together to build a common goal or a common business. That's usually the form that mergers take. For an acquisition, the power is a bit more unbalanced. So it will either be your company or another company that will buy someone else and kind of integrate the services. So somebody is leaving the company in an acquisition. An exit is slightly different. So that would be a more general sale, or I'm very sure that most of you already know the most common form of exit is an IPO, so your initial public offering, where you list your shares on a public exchange.
Great. So it's useful to have that background, because I think the focus of this webinar, because in particularly with private companies of the scale that we tend to deal with, we deal a lot with acquisition of shares and the sale of shares. So the focus of this webinar will be principally on those. However, it is possible in an acquisition for there not only to be a share sale, but also an asset sale. So again, just before we move on, it's probably useful just to distinguish between those two things.
Yeah, so a share sale, it is what it says on the tin, really. So it's a sale of your shares. What that means is that everything that the company owns goes across with your shares. If you're doing an asset sale, it's slightly different. You're not selling your shares, but what you're doing is you're selling individual pieces of the company. So you can pick and choose which ones you sell and which ones you keep.
And is there advantages either to sell or buy one over the other, or they're pretty much the same thing?
Yeah, so they're slightly different. From a buyer's perspective, sometimes they do like to do asset sales just because it means, like I said, they can cherry pick what they want. So they don't have to take on your company's liabilities, but they might, for example, want to take on the brand or the IP, which could be really valuable. As a seller, you'd probably prefer to do a share sale, particularly if you wanted a clean break from the company, because it means that everything will go across. The process can be slightly smoother and you do get a clean break.
Right, so that's obviously on the legal side and also on the kind of practical transactional side, but there's presumably tax differences between the two as well.
Yeah, so each case can be different depending on sort of the size of the deal and the structure of the terms of the deal. Primarily, if you're selling shares, then that's a sale being made by the individual of shares, so the tax is immediately on the individual. The tax would fall under capital gains tax, which is one of the lower tax rates that the UK has. And generally, capital gains tax on the sale of shares will be taxed at 20% on any gain made on the profit of the sale. So that's sale proceeds less original cost of purchase. The UK also has something called business asset disposal relief, or commonly known as entrepreneurs relief, which means the first £1 million in your lifetime, that's a lifetime allowance, would be taxed at 10% rather than 20%. So selling shares in that way is a pretty tax efficient way to realise value in a company. The difference between that and selling trading assets is that if trading assets are being sold, that's being sold by the company to another company. So the tax is immediately raised on the company selling. That would fall under corporation tax, again on the profits of the sale, and the corporation tax rate currently is 19%. The issue that can sometimes end up with is that the founder as an individual then owns a company which has probably quite a lot of cash because it's sold its assets and trade, and potentially not a lot else. So the individual then has to extract that cash personally to gain anything from the sale. And this can be done in various different ways. Drawing on a salary being one, which would not be very tax efficient, but you can also release the funds through dividends, which can fall under a very low tax rate, or even payment into a pension scheme, which could be completely tax-free. So there can be advantages from either side, depending on the deal, in whether you might want to sell shares or trading assets. Generally, for larger deals, as Freddie said, the share sale is probably beneficial. It provides you with a clean break from the company. And also, in larger deals, it would take a lot of years to extract the funds in a tax-efficient way from a trading asset sale. So primarily, selling the shares outright is beneficial. One small caveat on that might be that from the buyer's side, they might only want certain assets of the company. They might only want to purchase assets and trade, because that way they can leave behind any liabilities or unknown liabilities in the old company, which would still be under your ownership. So quite often the buyer might push for a trade and asset sale, whereas in the seller's mindset, by and large, it's best just to sell shares from both a legal and tax point of view.
And there's just something to be aware of as well, that when you start out selling your business, it's not always the case that the transaction you start with is going to be the transaction that you end up with. So you could, for instance, start by saying that you want to go through a share sale, but then obviously the buyer does their due diligence and maybe some liabilities are found, and then you could end up having to negotiate an asset sale instead. So that's something just to be aware of, that it's not always smooth sailing and it is part of the negotiation.
Great, thank you. Yeah, so for the reasons that Craig and Freddie touched upon, we are, as I say, going to focus more on share sales because they tend to be the most common ones that we come across. And in the kind of classic sort of startup world of a sort of a 5-year exit plan, that tends to be the direction of travel. So what we're going to do, just loosely put forward a scenario which may be familiar to some of you may be in this position. We're going to imagine two founders of a tech company which is pretty rich in intellectual property. Let's say they've developed some kind of tech platform, proprietary intellectual property. They have a 5-year plan for an exit. They want a big sale, and they're around, say, 3 years into that 5-year plan at the moment. Historically, just to give a little bit of colour, they may have taken investment from angel investors to start off with, and then taken on investment from a VC. The two founders are still completely key to the business, and it's likely they'll be key to the business moving forward. And I say the plan is to sell out the whole of the company. So we're going to use that as sort of a basis scenario, and perhaps I can bring James in here just to ask, what should these founders, or founders in general, but perhaps linking to this scenario, what should they be thinking about, what should they be planning in order to, I suppose, best realise the value of that business?
So I think that the scenario that you created is quite a good one, because 3 years into a 5-year plan leading up to the sale of the business gives founders a really good opportunity to take a step back and actually look at the business that they're building. And that's difficult. You don't always get to do that when you're running a business, executing on your strategy day to day. It's sometimes difficult to take that step back. but 2 years out is a good time to do that, because what you're really trying to do at that point is think about the perceived value of your business from the perspective of a third party or someone who's potentially going to acquire the business. There's lots of different ways that you can value businesses. You can just look at revenue or profit or even EBITDA. But what we would always recommend is to think about the value of your business in terms of enterprise value. And what enterprise value really does is it breaks your business down into individual building blocks, all of which together contribute towards the value. And when taken as a whole, it's quite a holistic way to look at it. So it would include things like looking at the cash that you've got in your bank, corporate documentation, your corporate structure, your assets and IP, your people, your shareholders, and depending on what type of business you have, there'd also be more specific scenarios. But as a starting point, I think generally that's quite good. And what you're trying to do effectively is then to think about probably the most useful lens is the 3 stages of due diligence that a potential buyer would go through when they assess your business, which is then commercial due diligence, legal due diligence, and accounting due diligence. And effectively what you're trying to do is you're trying to maximize your consideration, which is the price that someone is willing to pay to acquire your company, whilst reducing risk. So as a founder, you started a company, you've put in all that hard work to build it up, scale it up, get it to a position where you're able to sell it. You then want to maximize, obviously, the value that you get from that. So starting to plan from that around 2 years out is likely to help you increase your chances of finding a buyer, increase the total consideration, but then also make the sales process more efficient and less costly because you've thought ahead about due diligence and mitigating any risks that might come up.
And so the idea behind thinking about due diligence is, I say, as you pointed out, due diligence is a process that the buyer goes through. But you're suggesting here that, in fact, it should be the founders and sellers who, in advance, should almost be putting themselves in the position of a buyer to kind of stress test their own business.
Yeah, you should be thinking about, okay, we've built a business. Who is likely to want to acquire this business? One obvious answer is bigger direct competitors, but a less obvious answer might be adjacent businesses where there would be a competitive advantage from bringing your business model into theirs. And then thinking about how they're likely to look at your business, the risks that they're likely to be sensitive to, the business case for acquiring it, and really scenario that out and try to be really quite objective in looking at it.
Great. So as you say, there's 3 types that you flagged up there, and I suppose we're jumping ahead slightly insofar as we're now going into imagining that a deal is in place. But I think it's useful to talk about due diligence now and some of the specifics. So on legal due diligence, what does that entail? Can you give us a bit of an idea?
Yeah, so legal due diligence is often something that founders come to us and they don't really know much about, or they think it's to do with the administration of things. Whilst that's partly true, it can be quite a big part of the deal. What it will mean is that the buyer is going to look through all of your documents and all of your filings at Companies House. They will be looking for things like board minutes for every material decision that you've made in the company. They will be looking to make sure all of your cap table and statutory registers are up to date, that you've done all of the shareholders' resolutions that need doing in relation to giving you consent for the company to do certain things, and that these are all properly filed at Companies House.
So if that being the case, what should founders be thinking about doing right now, even if they're still a couple of years away from the exit?
So there's a couple of things I would suggest that you start doing right now. One is to, whenever you're making a big decision or there's a big transaction going on within the business, is to get some legal advice on what the consents are and what you need to file in relation to those. And I know it sounds a bit counterintuitive that you'll be spending out money on advice now, but trust me when I tell you it's far more costly and far more time consuming to try to unravel these kinds of transactions and fix them all up during a deal to get you ready. So that's one thing. The other thing is to be proactive in the contracts that you're signing with other parties. So, for example, there's a particular provision that you might see in some of your contracts, which is called a change of control clause. And what it does is, if the company changes hands, it allows the buyer to terminate the contract. The other party, to terminate the contract. And obviously the buyer doesn't want to see this, because if somebody was purchasing your business, looks through your contracts and can see that the contract can be terminated as soon as they bought the company, that's a massive red flag. So to get those kind of provisions out of your contracts now, whilst you're negotiating them, is much, much easier than having to give indemnities and things to the buyer afterwards. to recoup any loss that they might experience because of that.
So in your example there, you get a buyer who comes in, they might agree a particular price to acquire the company, but then when they start looking under the bonnet and kicking the tires, they find this contractual problem, which presumably gives them, it sort of strengthens their position in one sense, because they can ask for money off the price, or they could ask for additional indemnities in any agreements. So.
Exactly, yeah. So these are quite big things, and they can leave big gaps in the transactions if they're not done properly. So you should expect quite a significant reduction in the price if that were to happen.
And going back briefly to our scenario here, if you've got a company which is quite rich in IP, or should be rich in IP, and that's the main asset of the company which is being sold, what additional things might they think about in terms of preparing for due diligence?
So just have all of your IP registered as much as it can be. Make sure you have all of your IP registrations paid and up to date. You can go online and check these yourself. Make sure you have all of your papers in order, that you know who owns what, and if there are any licenses to use the IP and the extent of those. And basically making sure, and James touched on it earlier, doing perhaps what you could call a mini due diligence process on your own company, is making sure that if a buyer were to look at all of your IP documents, is it clear that the company can continue running after they've bought it on the licenses and on the patents, copyrights, trademarks that it currently has?
I'm afraid actually, I mean, in the scenario we painted earlier is one where a VC has invested already, and actually the due diligence process presumably would be quite similar to when the VC would have come in the first place.
Yeah, exactly, yeah.
Right. So there's a good overview of the legal side of things. Obviously, there's the financial, there's the tax, the accountancy side as well. Craig, could you speak to that?
Yeah, so obviously this is something that the buyers will take quite a keen interest in for two primary reasons. Firstly, they'll have looked at draft financials that you've provided to them, or possibly might already be on public record, and they'll want to know that what's been presented to them is an accurate representation of the truth. They'll want to know things like the valuations are correct, the ownership is in place, that assets exist, but also that liabilities have been properly disclosed and properly valued, and that the sort of commercial story that the financials are telling is true and reasonable. If they're sort of viewing financials that are showing a growth rate of X% every year, then they're going to find that very interesting to invest in. But then obviously they want assurance of if these financials are actually accurate and can be relied upon. So I think the financial due diligence process is a really key part of the sale process. The process from both the buyers and sellers side is similar to that of a financial audit, in a sense that first you have a consideration of risk. The risk in this case, in the vast majority of cases, would be that the seller might want to overstate the performance or the assets of their company and understate any expenditure and liabilities. So various financial audit processes run through to ensure that isn't the case, and provide assurance to the purchasers that everything is as it appears, or highlight any possible materially risky areas in the figures or areas which might be subject to judgment or interpretation, and just sort of really get under the bonnet of the figures and highlight areas which might not be quite as they seem. Further to that, within sort of UK transactions, the tax perspective is quite straightforward, but you would definitely go into some detail, liaising with HMRC to ensure that there's no unforeseen liabilities with corporation tax, if VAT has been properly applied and paid, employment taxes, income tax, PAYE, and all that sort of stuff. I think possibly a final aspect would be for high growth businesses. A lot of the time the selling company has quite ambitious growth plans, will have forecasts that show growth year on year, and part of the financial due diligence process would be to sort of look at the underlying assumptions on which these forecasts are built. If forecasts are built on estimates and assumptions which are unrealistic, then the forecasts themselves are likely to be unrealistic and therefore unreliable. And that's, again, something that the buyers will want to ensure is in place at the outset, just the case that everything is built on reliable and achievable assumptions.
And so, again, similar question asked to Freddie here, if someone's either about to go into that process with a buyer due diligence process, or they just want to get their house in order now, what kinds of things could they start doing?
I think it's definitely worth doing a couple of years before you go into the due diligence process, because as Freddie said, it can take a lot of time and be quite costly to unravel mistakes and then build everything back together. So the temptation with a lot of founders, especially in their early years, and while they don't have so much cash, is to sort of possibly look after the finances themselves or use a cheap part-time solution. Whereas if you're a serious company looking to raise serious investment or go through a share sale, you should be looking to have a fully qualified accountant on board. That doesn't always need to be a full-time employee. It can often be a part-time employee or even an outsourced solution, just to make sure that people that properly informed, financially qualified accountants are looking at your finances on a regular basis to ensure that no issues grow and develop over time, which could really cause issues in a due diligence process.
Absolutely. And James, I know you talked earlier about enterprise value and building that, and you talked about that third strand, the commercial due diligence. How does that come into play?
Well, I think the commercial due diligence is somewhat less of a process, but it kind of, the commercial case, if you like, waterfalls down from everything else that we're talking about. And it's looking at really the business case for an acquisition, like how attractive a proposition is it for an acquirer to come in and buy somebody's company. Having said that, there are probably four things in particular I think it's worth mentioning. The first is your ability as the founder to display or communicate your product market fit, which is a very common concept, especially within VC-backed businesses. And that is essentially your ability to demonstrate that your product or solution solves a common and important challenge. And the way that you would do that is by, as Craig mentioned, drilling down into your numbers, looking at the quality of your revenue, ideally wanting to see that it's highly repeatable, highly reliable. It doesn't just come from a few big customers, which obviously would represent a significant risk for an acquirer. The second level of that is your go-to-market strategy. You can demonstrate that you've got a desirable product or service, but can you then reach your audience? Is the audience big enough for you to scale the company? And do you have a strategy to reach those people? And then finally, the competitive advantages, really, again, it's for a founder, it's taking a step away from your business and thinking about the competitive advantages that can be gained from an acquisition of your company, opportunities to cross and upsell between the two joined up businesses. And that's why adjacent businesses are as important to look at as direct competitors, because there will be adjacencies that can be taken advantage of. And I think all of that really, that comes across in discussions with an acquirer, but it also comes across in probably the first document that you put together, which is your information memorandum, which is really the pitch deck for your business when you enter into this particular sales process.
And presumably, I mean, most of the things you mentioned there are things that I suppose, even if there's no exit plan, business owners should be doing anyway.
Well, this would definitely be best practice in terms of running your business and thinking about these things. But for any founder that's on this webinar and listening to this, they'll know that there is a huge challenge of running a company, which is being able to step away and think about strategy when you're dealing with day-to-day execution. And this is just a kind of extension of that challenge, I suppose.
And so, I mean, with all that in mind, is there, again, any specific takeaways, any specific recommendations for any founders listening as to what they can do right now? Is it just a self-audit? It's just a kind of, what would you
think there's two things that I would take away from this. One is finding that space to step away from the business, out of the office, out of your normal place of business, to really step back and analyze the business. And there are different management tools that you can use for this, but the one that we recommend is an enterprise value diagnostic, which basically gives you a very extensive set of questions which you go through and answer as honestly as you can. And out of the back of that, your different parts of your business would be scored. And that effectively gives you a prioritized operational plan through which you can then go through and try to focus on the areas most likely to achieve growth. Mm-hmm. So that certainly would be one. The second, which is more based on my own personal experience, running my business, then going through a sale, is we didn't really invest as heavily as we should have done in having good financial information. I think that we used more of a cash accounting basis to handle, the accounts for our business. And that was fine, day-to-day running the business to an extent, but when we came to sell, it caused us significant problems, which really slowed down the sale process, really had an impact on our consideration. So I would always recommend it. It can sometimes feel like an unnecessary expenditure, as Craig alluded to, but investing in making sure you are really well informed about the true health of your finances is invaluable, I think.
Right. And on that note, you talked about understanding adjacent businesses, also understanding competing businesses who might be potential candidates to acquire the company. What is the process? What do the founders actually do when they want to go out and actually get, have their company sold? What's the process?
Well, I think like most things in life, these things can be overcomplicated. And of course, this will likely be the biggest transaction that you go through as a founder until you start your next business and maybe build up to a sale of that one. So it feels big, it feels complex, but actually it is a sale process like anything else. And really, you've got two options. You can either self-represent through that sale process. That effectively means doing a market mapping exercise, going out and thinking about the types of businesses who would acquire you. Building a prospect list of those businesses and then creating a strategy to reach out and engage with them. As I mentioned before briefly, developing the collateral, we will need to do that. So things like an information memorandum, making sure that in advance you've got your business plan, your financials produced and together, because they're going to be the first things that an acquirer is going to want to see. Alternatively, you can engage the services of a broker, and they will be sector specific. They'll know the market in which you operate. And really what you're doing is you're relying on their existing network, their knowledge of the market, to give you somewhat of a shortcut to identifying those people likely to want to acquire your business. The caveat there is that most brokers will work on a retained fee, so you are paying for that time save, and then you'll also be paying a success fee based on their ability to actually take you through the sale process. Conversely, what you're gaining by using the broker is a third party who can negotiate on your behalf. So something that I think we'll touch on later is that in most of these transactions, there's likely to be an earn-out. When you're negotiating back and forth, if you have a third party representing your interests, it can preserve your relationship with your eventual acquirers.
And so once, best case scenario, a potential acquirer is found, initial conversations happen. I mean, can you touch on a bit more about that process and where that leads to?
Yeah, again, I think this is why I liken it to any other sale process. You're trying to engage, an interested audience, and you have some marketing collateral which you use to do that. But effectively, you have an outreach program where ideally you're probably emailing and following up with calls with individuals, companies, buyers, the right people with the right remits at those organisations. And effectively, what you're trying to do, you're trying to get your IM, your information memorandum, in front of them, so they get a sense of what your business is, and you're presenting the business case for to purchase your business. And then once you have someone interested, there will be a series of conversations. This day and age, probably Zoom meetings, face to face, over the phone, to go into more detail to really, as Craig used the phrase earlier, to get under the bonnet of the business. Off the back of those conversations, they'll be drilling down in more detail, asking to see more detailed documentation, more detailed forecasts, your management accounts, so on and so forth.
Great. And so, returning to our scenario here, let's just imagine that these founders are now 5 years into their 5-year plan. They've found some acquirers or potential acquirers prepared to pay £10 million for the company, let's say. They've insisted that those two founders need to stay on after completion of the acquisition for 3 years. They're now at a stage where they're negotiating their heads of terms. And I think this is useful because heads of terms essentially, before full documentation is drafted, papering up the transaction, whether that's the share purchase agreement, disclosure letter and everything else, the heads of terms essentially set out the main structure of the deal. So I think it's a good way of us looking at the structure of the deal.
Just on that, sorry, James, what I should have referenced before, of course, is through this sale process, this outreach activity, that is the point at which you're trying to get a potential buyer to. You're trying to get them to express their interest by submitting a heads of terms.
Yeah, exactly. So once that happens, that expression of interest arrives, term sheets arise, and that can be negotiated. And once it's settled, it will set out the main structure of the deal. So, Freddie, what were the key terms of a deal, you know, referencing this scenario, what would the key terms of the deal look like?
Yeah, so as you already said, the heads of terms is basically a combination of the terms that have been agreed on which your actual share purchase agreement, which is the formal agreement, will be based. So ideally, you want to have as much agreed within your heads of terms as possible. The main areas that we usually see in heads of terms are the first one is costs, which is obviously quite a basic one to have. Everybody's worried about costs, but it is important that you do agree on this. In most cases, parties should pay their own costs, but we have seen it, and it does happen where if you've got a particularly say demanding buyer, or you've got quite uneven bargaining power, or the transaction is going to be particularly complex, or there's some sort of risk to the buyer, they will sometimes ask for you as the sellers to cover some of their legal costs. So that's one thing that you should be open and frank about in the beginning, because obviously that does affect your cash flow. So again, that is something that should be discussed, because there have been cases before where there's been nothing about costs in the heads of terms, and then it comes up halfway through the deal, and it's just such a silly point for the deal to be turned on its head for. So just be aware of that when you go into it. Another one that's often hotly negotiated, especially from the point of view of a founder, is exclusivity. So this is basically the buyer saying to you, okay, I want to buy your business. I've come to you with this deal. I've carried out a certain amount of due diligence already. So, you know, I've put some time into this, and I want to make sure that you're not going out and asking everybody else if they'll buy your business whilst we're doing this. So usually you're locked into a period, which could be anything from 4 to 6 to 8 weeks. Obviously, from your point of view, you want to negotiate this to be as short as possible. You don't want to be locked in, and you want to be able to, you know, scan the ground and see if there are any better deals out there. So one thing to bear in mind as well before you sign the heads of terms is that you have to be sure that you have had a good look out there, because you may well be locked in. Another thing is consideration, which is the purchase price that you're going to get for selling your business, which is one of the main points. So there are different types of consideration. You could be paid in shares, for example, in another company, or you could be paid via cash, which is usually the one that we see most often. There are also different structures of consideration. So in this case in particular, because the founders are so entwined into the business and they want to keep them on for 3 years, what you would usually see is something called deferred consideration. So you might receive an upfront payment on the completion date, which could be anything from, say, 40 to 80% of the overall consideration price. And then the rest of the consideration might be deferred once you hit certain milestones within the company, and that would come later. That's often referred to as an earn-out. So deferred consideration doesn't have to take the structure of an earn-out. It could just be deferred to another point in time because that's convenient. But most often when you have a founder that's staying on, we call it an earn-out because the deferred consideration is only paid once the founders or the company hit certain milestones. So they can be financial. So for example, if the founders are here for 3 years, they might say to you, okay, you can have 8 million of the funds up front now on completion. And then for each year that you have a gross profit of, I don't know, say 2 million or more, you'll get the extra consideration. And that's something to really think about and to really look at in your heads of terms, because there have been cases where sometimes the heads of terms mention deferred consideration or earn-outs, but the terms haven't properly been looked at or considered. So one thing to be aware of as sellers yourselves is the fact that some earn-outs can be all or nothing. So for example, if you do have an earn-out where you receive a certain amount of consideration per year, if the company reaches a certain milestone, there should, or we would say there should, for you, be a chance for you to make up that consideration in a rolling year if you haven't hit the target in the first year. So it shouldn't be all or nothing. There should either be a chance for you to make that up, or the consideration should be pro rata. So those are things to be thinking about as well.
And sorry to interrupt, presumably on that point as well, it might link back to what Craig was talking about in terms of financial forecasts, because if the earn-out is based upon the company's financial performance, which has been projected, you can't say, well, we're not going to hit these numbers if you've essentially sold the company on the basis
of to balance between making the future of the business look as attractive as possible for a buyer, but then knowing that you'll probably be incentivized to try and achieve some of that through an earn-out. So you have to be pragmatic about it as well.
And presumably as well, we're talking about this idea of founders, and going back to your enterprise value of that commercial audit that you do. If the founders don't really fancy hanging around for 3 years, then probably that's something they can think about beforehand and talk about whether the company is too over-reliant on them.
That's a further point that I would always say. When you get to that 3 years in the 5-year plan, you want to be really making sure that your business isn't overly owner reliant, because that would considerably drive down the valuation that you can achieve. If you're selling your business, obviously you want it to be self-sufficient. You don't necessarily want to be hanging around in the business once it's been sold. But if that business is inherently reliant on you as an individual, then the valuation of the business will be considerably reduced if you're not keen to stay around in a business that you don't own in the future, which would be fairly normal.
I think as well, as if there are any founders who are watching this as well, obviously founders often see their companies as their babies. They don't really want to give them up, but in order to truly achieve value, you kind of have to, I think. So, sorry, continue, Freddie.
That was actually a great thing pointed out by James there in relation to the fine balance between having your forecasts be as accurate as possible and obviously going into this earn-out. There's another reason why that is so important, and that's because there will be warranties and indemnities within your heads of terms. So they won't be listed out within the heads of terms, but you'll probably find that there's a clause in there that says something like sellers to give standard warranties and indemnities in the share purchase agreement. So what these are warranties or statements of fact about your business that you have to be able to stand behind. And if you can't stand behind them, you have to disclose against them in what's called a disclosure letter. And that protects you in terms of your liability. Warranties are connected to your personal liability. So it's not the company that will be paying if something's gone wrong or something's misleading. It is you personally. So every time you hear the word warranty, your ear should be pricking up, alarm bell should be ringing, and you do need to review those carefully. I'll give you an example. So let's just say we've got this IP company, and there's a warranty in your share purchase agreement that says my company owns all of the IP. And then let's say, for example, your company actually only owns half of the IP. You would have to disclose against that warranty and put it into a disclosure letter. If you don't do that, and there's a breach of warranty, then you will be personally liable for all of the loss that the buyer has incurred in relation to that. So, for example, costs like they're not able to run the business because they don't have the IP, the business wasn't worth what they thought it was worth, that would all come down to you personally. So it's really, really important to review those warranties when you get them in the share purchase agreement, and also to look at any indemnities.
But going back to what we talked about already, if at year 3 or before that, you had actually carried out a full audit of your business and understood where the IP lies and ironed out those problems at that stage, then you should be very comfortable giving those warranties because you would be able to stand behind it.
Exactly, and you have much, much less personal risk. Another thing that I would suggest is narrowed into terms is, in this scenario, if you have the founders that are staying on, presumably you would want a service agreement. You should always have something in writing, especially if it's related to an earn-out. You need to know what you need to do to be in compliance with obviously your service agreement and to be able to meet the targets of the earn-out. One thing that I would recommend doing before you enter into discussions, because I know that founders often do this, obviously when they first start the company and they maybe isn't so much cash, they usually take a discount or only part of their salary. So the service agreements that they're on with the company prior to the deal might actually not be reflective of market value. And what you don't want to happen is for the buyer to come in and say, yes, you've got a service agreement on the same salary that you're on, and then actually it's not market rate and you're being paid less for a job that you were doing.
So yeah, so part of this is negotiating the terms of the founder's employment.
Yeah, exactly.
I think there's probably a final point I just make about the heads of terms as well, and that is that, again, there's a real balance to be achieved here, because as the seller, you are wanting to maintain the momentum of your sale process. You're wanting to get into the due diligence to get closer to that completion point. And whilst the heads of terms is not a legally binding document, it is a document that you will review, agree to, and effectively sign. And at that point, it can be difficult to backtrack from things that are in there. So whilst you want to maintain that momentum, I think it's a really good point to stop and really consider what's in those heads of terms as Freddie has outlined. And probably if you are self-representing, if not at any other point, take some advice on what's in there, because some things do need interpretation.
Yeah, and James is right. It's very, very, very difficult after you've signed the heads of terms to be able to either renege on something that's in there or add something new, unless you can really justify it. And obviously that also has implications in terms of cost and time, attractive negotiations. Worst case, it could scupper the deal. So it's just really important that you do, before you sign anything, have a review and that you're happy with what you're writing.
Brilliant. And I say, we're not going to dwell on what then happens afterwards. The heads of terms then leads into full negotiations of the principal documents. I think it's probably too technical to get into those, and Freddie's already touched upon what they are. I'm going to ask Craig just to wrap up in terms of talking about tax treatment of these. I thought before I did, if you did have any questions, it's probably a good time to put them into the chat now. We can come back to them once I've asked Craig. So yeah, please, if you've got any questions, just pop them into the chat. So yeah, I was going to ask Craig, I know you touched on tax treatment a little bit earlier in terms of share and asset sales. What are the general tax implications of a transaction in this scenario?
Yeah, so this scenario is fairly straightforward, given we've opted for a sale of shares, which, as I touched on earlier, this would be beneficial from a tax perspective of a sale of this sort of value anyway. The tax is going to be caught under capital gains tax, as I discussed. That's 20% of the profits of your sale. So in this instance, if the founders are selling for 5 million each, it's likely that 20% of that will be 1 million. If the founders have not used their lifetime allowance of entrepreneurs relief, they'll manage to reduce the tax rate on the first 1 million down to 10%. So the total tax bill of them selling 5 million each would be around 900,000. The only slight complication would come out of the earnout that was discussed by Freddie earlier, because in this instance, the actual consideration, the proceeds that you're receiving for the sale of the business are not ascertainable at the point of sale. And in this instance, what you have to do is make a best estimate of what the earnout might be worth. So you sort of create a valuation of the earnout, and then you declare taxes on that amount immediately and upfront. And then further down the line, when the earnout is completed, you either pay tax on the extra proceeds over and above what you expected initially, or you reclaim tax if the earnout did not turn out to be as valuable as what you initially expected. The only thing I need to add on to that is, in this case, obviously, with an earnout, some of the cash that you receive for the sale is deferred. It might be 1 or 2 years down the line. And in these instances, HMRC do allow application for payment of tax in instalments. The rules around this are quite technical. I won't go into details, but they do provide for the case that obviously they're not expecting you to pay tax on cash that you're going to receive in the future, although they do expect you to declare it and fill out the relevant forms to them. They do allow a payment in instalments.
Right. So I don't know. Do we have any questions? No. So we have a couple of questions here. Thanks for these. How does debt affect a sale? This might be one for you, Craig. How does debt affect a sale? Is debt bad, or is having a safe level of debt and paying it off, does that show you're able to run the business well?
It's a difficult question to answer because it would fall into the wider context of what's going on with the business. I think you've hit the nail on the head with the second part of that question there, in that it can be used as a positive in the business. If the company is fairly cash rich and it has the ability to service the debt, or if it's creating profits that would service the debt, then there's no reason why it would be seen as a negative. Often that debt could be a major part in actually creating the profits that are deriving the value of the sales. So often businesses, especially in their early days, are reliant on debt. Mostly businesses in their early years have to be funded by something, whether that's debt or equity. obviously pros and cons to both. You can fund your business with equity, but then you're giving away a percentage of it, and in future you'll only receive your percentage of the sale proceeds. With debt, then there's money to be repaid, and like I said, there's pros and cons on both.
Coming in, this is how do you treat directors' loans in this situation?
Directors' loans, a lot of the time, that could be net off with the sale proceeds of the transaction. I think it's unlikely if an acquirer is looking to purchase a company that they particularly want directors' loans of outgoing directors hanging around on the balance sheet. So that's something that's likely to be net off with the sales proceeds. Similarly, possibly with small amounts of debt that were not material to the business, then they might try to pay that off in the sale process, if possible. Otherwise, if the debt was a material issue, that might be when you look at possibly looking at a sale of trade and assets, where the buyer has no interest in the debt and they just want to buy the trade without the debt, then that could be a further option.
We have another one here, which does come up a fair amount, which is, what do you think is the best way to value a company? Multiples versus DCF. If multiples, is that of revenue or EBITDA? It's always a thorny one, the valuation of companies.
I think there's valuations of companies come a lot in lots of different areas of work that we do at Dragon Argent, and I think that the key to remember about valuations is that they're an art, not a science, and that from a founder's perspective, the most important thing, whichever metric you use, is to make sure that it is defensible as possible, and that you've got the materials that you need, whether that's through working with a really good accountant that's producing regular management accounts to be able to defend the valuation that you pick. I think what is really helpful, and this goes back to this idea of doing taking a step back from your business, doing the enterprise value diagnostic, is part of that is also looking externally outside of your business at types of companies that are being acquired, how the terms under which they were acquired, the multiple that was used, the valuation that was used, going out speaking to people. I'm probably biased because I have more of a sales background in my career, but I've always thought go out and talk to people to get the answers that you need. People will give you time. So go out and find out what is the norm in your industry, and then you'll have that to fall back on.
I think what I would add on to that is that I can't quite recall the phrase, beauty is in the eye of the beholder.
Oh, yeah,
right. So you need to think of the context in which the business is being sold. If you're simply selling your business because the profits and the cash flow are attractive to the buyer, then it's going to be valued on a discounted cash flow method. However, what you might have in your business might actually sort of complete a jigsaw for another business and make them inherently more profitable. In which case, you might have a valuation which is X if you're selling to a general market, but Y if you're selling to a very specific company that values what you have in a very different way. So you always need to be considerate of who you're selling to, what their motivations are when you're considering a valuation. And just for context on that question, a separate webinar that I held personally a few months ago actually took around 6 hours to discuss valuations of companies. They are very intricate and go into various level of detail on different things. One that I mentioned earlier was owner reliance. That can have a significant impact. And it comes back to what James said earlier about thinking about your enterprise value 2-3 years away from the sale. Because it really is built on so many things, sort of the reliance and the recurrence of the revenue streams, how strong those revenue streams are, how well spread they are, your reliance on key clients and all that sort of stuff. There is sort of infinite numbers of things which impact on evaluation, hence why it is not a calculation or a science.
I think we probably should wrap up, but there is one other question, which is just what's the realistic time frame for a sale? I suppose we can divvy this up into different things. I mean, there's obviously starting to think about the sale, to finding a buyer, to negotiating, and then to completing the legals. I mean, I don't know who wants to go first on that.
I think there's probably no one size fits all. As a company right now, I know that we're working on maybe 4 or 5 transactions of companies which are going through the M&A process. Some are proceeding very, very quickly. Others are being spread out over a period of months. I think typically I would be always thinking that a very quick sale process might be 3 months, and a long one might take another month or two after that. But as with most things, erring on the side of caution, giving yourself longer is good for no less reason than from a kind of negotiating standpoint. If you are in a position when you need to sell because of the time frame and the other factor, that puts you in a weaker bargaining position where you might have to accept terms you might not have otherwise done. So give yourself time, but I think 6 months as maximum feels about right to me.
Yeah, I agree. And also, obviously, when you come to instruct your solicitor, ideally you would have most of your heads of terms agreed already. So from that point, it would probably take about 12-ish weeks, I would say, is generally standard. Obviously, as Jane says, it's not one size fits all, and it will depend on the particular nuances of your transaction. But about 12 weeks from being instructed on the heads of terms to prepare all of the legal documents for the negotiation back and forth. Due diligence, that's another timing that you should be aware of. That can take weeks or months, depending on what kind of due diligence process that the buyer wants to have. So you can have a quite limited due diligence process, or you can have a very extensive one, but that also needs to be done. Sometimes it's done in parallel to drafting the legal documents, but often what we find is that founders come to us and they've already kicked off their due diligence because they know how long it takes.
I think the final point on that is also to take into consideration how long you prepare for the sale. At what point you start thinking about gearing up for a sale, because Craig might have a different take on this potentially, but maybe a more accurate take on this. But buyer is going to look at probably at least the last 2 to 3 years, if not the last 5 years, your accounts to look at your financial performance, your financial health. So you don't want to be deciding right in 6 months we're going to sell, because you won't be able to paint the picture you might like to paint about steady growth and all the rest of it.
Absolutely. Well, thanks for your questions, everyone. Just very quickly, I think we've pretty much reached the end of our time. I just thought I'd just wrap up with a couple of comments, which I think, kind of the main takeaways I think we've been trying to get across here, which is that whether it's this scenario or your specific scenario as a founder, and you're looking to sell in the next couple of years, it really is, I say, case, put yourself in the shoes of the buyer. And understand what makes a company attractive to a buyer, understand the risks and the weaknesses, the enterprise value that James talked about earlier, how that affects the value of the business, what your assets are, what is attractive within your business. Carry out a bit of an internal audit of those things. Also consider, as we also touched upon, is there an over-reliance on certain clients, certain contracts, over-reliance on certain individuals within the company? That can drive down value. Not only can it drive down value, but if there is that over-reliance on individuals, that you as founders will be bound in for longer after the transaction. So consider also what it is that you're looking to achieve from a lifestyle perspective. Do you want a completely clean break, or do you want to hang around post-completion for X number of years? From a more kind of compliance perspective, as Craig and as Freddie touched upon, and put yourself in a position of a buyer who looks and you've got, pristine folders of all your contracts and all of your filings and everything else, which is in really good order, very understandable and digestible. Similarly with all your financials, do you have monthly management accounts in place which paint a picture of your financial history over the last couple of years? As I say, a buyer coming into a mess can lead to the buyer pulling out altogether, or possibly just driving down the price of the deal. So again, I think those would be some big takeaways there. Unless anyone has anything to add on those, that's I think ideally what we want you to take away from this. We will be following this up with an email to you all with a link to this webinar. If you did want to watch it again, I'm sure you will do. And you'll also be given opportunity as well. If you'd like to schedule a call with one of the team, you can book that in via the link that we'll send across to you. So thank you all very much. Thank you to Freddie, James and Craig. And I hope you join us for the next webinar. Thanks so much.